Hello, everybody. This is Eddie Ghabour, CEO and co-founder of Key Advisors Wealth Management. Please subscribe to our YouTube channel for up-to-date videos and educational input that we try to give investors to try to help them and their families get into a better place. So I'm shooting this mid-December. It's December 13th. I just got off of Fox Business with Stuart Varney. And I wanted to shoot this video to kind of show a recap of this past year. Talk about some of the things that we got right, some of the things that we got wrong, and what we think the setup is for next year. And of course, these are our opinions based on our research and how we look at the world. You make your own determination on what you think is best for you and your clients. I'm a big believer in accountability, especially in this business. People trust us to manage 40, 50 years of hard work. So there's no time to BS people when it comes to their net worth, and we take risk management very seriously. One of the biggest things we got wrong in 2023 was we came into the year expecting a recession, and we expected the market to not have a great year. And obviously now, as we see the rally off the October lows, there's still 2 weeks left in the year. However, we believe that the market will stay strong here in the month of December. So when we look at the end of October with the S&P only up single digits for the year, frankly, we thought, okay, our patience really paid off. We're going to end up looking as if we nailed it again, 2 big years in a row. And then we had a monster rally here of historic proportions that's now putting the S&P well into double-digit returns. So hats off to the bulls that stayed with it this year. The reality this year coming into the year was we were worried about a credit event, and we warned our clients about that. And we were right. We saw bank failures that caused a tremendous amount of volatility. The other area that we were right in this year was India. We put an India trade on. I believe it was sometime around June time period. We shared with our clients that their economy looks like it's accelerating and look very, very bullish. We still hold India today. So that's been a great investment for our portfolios. But make no mistake, this year, overall, I would not grade us an A+ like we did last year. I'm a very competitive person, and I want to be right all the time, even though I know it's impossible to bat 1,000. You sure can strive for that. So the reality is this year, the way the math works is people that rode the market all the way down the year before and rode it up this year is they're probably close to even. Okay, so it took them 2 years, in our opinion, to basically get to where we get to because we told everyone we were selling in December of 2021. So now as we go into the new year, using my competitive language, that's going to be the tiebreaker. So last year went to the Bears. This year will go to the Bulls. Next year will really determine who's right. The reason why we have continued to stay cautious is 2 reasons. Number one is the type of clients that we work with. We work with a lot of retirees. They don't have a very high risk tolerance, and their investment objectives are different than someone that wants to day trade or trade the moves in this market. So that's one. And the other reason why that we have continued to stay defensive is we cannot ignore the economic data. And yes, I know the economy is not the stock market. I've shared that with clients. I've used that same language. But ultimately, the economy and the stock market do meet, and it does matter. And there are time periods that it does not matter. And this year couldn't be any more obvious as we have seen the economic data decelerate. I don't think anyone can argue that growth has been slowing. But look, at the end of the day, the government spent a lot more money than many people anticipated to keep things afloat. So we believe this economy under the hood is decelerating much faster than investors are appreciating. And the government has kind of masked how well things are with this debt. And as we go into next year and you look at the comps of government spending, there's still going to be high numbers, but you're going to have a lot of stimulus that the government put into the system this year that won't be there in 2024. So if the consumer continues to get weaker, and look at the setup, right? This setup to me has a lot of similarities to the setup in December of 2021, where we had GDP really high, we had a market hitting an all-time high, and everyone was bullish. We generally go against the herd. And when we look at going into this coming up year, Look at the similarities. I mean, we just got a GDP print of over 5%. If you believe that number, that's what it was. And we are heading into a bullish environment right now where investors have really aggressively bought this and bid this market up. So we may have a new high at the end of this year coming off of a 5% plus GDP number going in to January, February, March. We believe that the GDP potentially could drop to sub 2% by the first quarter, maybe even fourth quarter. We'll get those readings in January. So think about this logically. If the economy goes from a 5% GDP number down to 2.5%, 1.5% by March, what do you think is going to happen to equity values and equity prices and valuations? In our opinion, it'll be very similar to what they did in 2022. You have to reprice. In our opinion, if you get the economic growth cut in half or 70%, again, there's going to be some strain on a lot of these stocks that are overextended. And here's the reality, whether the bulls want to agree with this or not. And let me be very clear. I'm not a perma bear or a perma bull. I look at the world objectively and give you my opinion based on that. I hate being bearish because that means things are bad in this country. But at the same time, I'm not just going to say buy every damn market, regardless of what the economic data says, because at the end of the day, I'm a fundamental investor. Okay. So when we take a look, one of the big benefits to investors going into next year, if you have cash, in our opinion, or treasuries or something short-term with low volatility, is this has been one of the most concentrated up markets in our lifetime. Okay. There have been a handful of names that have accounted for a big percentage of this market. And it's great when it's happening, but if you're only in a handful of names and those names break down, you're susceptible to some big downdrafts. Now, granted, we have seen some broadening out since the end of October, and that's really positive. But as we look going into this, even as I'm speaking right now, small cap stocks are still 20+% below where they were. We're seeing individual stock names that are yielding 7% and above that are still 30+% off their highs. And there are names and sectors I could list. We're going to go through it with our clients. But our point is the setup for next year for an investor that wants to generate income and own assets that have the opportunity for some really nice upside, I think it's the best setup we've seen in over a decade. Well, why haven't we bought right now, even though the yields are still attractive, and I would argue they are attractive? Because we believe that the economy is going to decelerate to a point that the spreads and the yields on these assets are going to widen. So something that's 7% now, maybe it'll be 8%. Maybe it'll be 9%. I believe you're going to get yields. Again, you have to manage it based on your risk tolerance that are going to be double digit in nature next year. And then you'll be in a position where you own a portfolio that is generating nice cash flow. And if it's enough to meet your standard of living, you're really winning at that particular time. Owning underlying assets that, in our opinion, over the long haul, has some really nice upside. I don't think the mega cap tech names are going to be the leader next year. If we have a positive year, I think you're going to see leadership in small cap names, potentially energy, because energy has really taken a beating here towards the end of the year. So at the end of the day, right now there's a big tug of war between the bears and the bulls. The bulls believe there's a soft landing and that the Fed's going to cut rates soon. The bears, although there are fewer and fewer, and my guess is by the end of this year, I might be one of the only ones left who believe that we will not have a soft landing. I believe we will have a recession. Granted, it may be mild in nature, but the stock market won't care. Regardless, I believe this economy will be cut in half at a minimum from a growth perspective, and stocks aren't priced for that. If I'm wrong, then we will just get asset prices at the levels that they are today, which aren't too bad with some of the things I just talked about. So I believe the risk reward right now over the next 3 months is to continue to be patient. We've been patient for 2 years, 3 more months, 4 more months. As we continue to follow our process, we think will make huge dividends for our clients over the next decade. At the end of the day, it's your decision on what you want to do for you and your family. So I hope you got some value out of today's video. as I shared some of the things that we got wrong, some of the things that we got right, but more importantly, looking forward, some of the positives that we see developing in this crazy market. But make no mistake, we are heading into a decade of record debt, and we're going to have tremendous volatility, higher inflation, and you need to be nimble as an investor, in our opinion. So we are not going to set it and forget it, but we do see a lot of opportunities that will be there coming in the next several months, as I just illustrated. Thank you. Have a great holiday, and I wish you the best.